Everywhere you look, artificial intelligence is the headline. On the front page of newspapers, splashed across social media feeds, and dominating conversations in boardrooms and coffee shops alike, AI is being hailed as the next technological revolution, a force that promises to reshape our world in ways we're only beginning to imagine. Companies and governments are racing to adopt AI, convinced it will transform everything from the way we work and communicate to how we diagnose diseases and manage cities. Investors are pouring billions into anything labeled AI, driving tech stocks to record highs in a frenzy reminiscent of the early internet days, when every new .com promised untold riches. The narrative is simple and relentless. Invest now or risk being left behind, as if missing out on AI means missing out on the future itself. But beneath the excitement and the bold predictions, questions are surfacing. Is this explosive growth truly sustainable, or are we witnessing the classic signs of a speculative bubble? Some experts warn that the hype may be outpacing reality, with many companies overstating their AI capabilities just to attract attention and funding. Much of the reported revenue comes from a closed circle of tech giants and ambitious startups, rather than from widespread, everyday adoption across industries. As we enter 2026, it's time to look past the headlines and ask, is AI truly delivering on its promises, or are we inflating a massive bubble that could soon burst? The impact of AI is already visible in our daily routines, but is it as revolutionary as we're led to believe, or just incremental improvements dressed up as breakthroughs? The stakes are high, not just for investors, but for workers whose jobs may be at risk, and for the stability of our entire economy. Let's pull back the curtain and examine the true mechanics of this AI gold rush, separating fact from fiction to understand what's really at stake. To truly grasp the fragility of the current AI boom, you have to follow the money trail from start to finish. The story isn't just about innovation or technology, it's about how capital moves and who ultimately benefits from this flow. Imagine a promising AI startup receiving $1 billion investment. It sounds like a huge win, but here's the twist. The startup spends the majority of that money renting cloud computing power from the very same tech giants who invested in them in the first place. The cycle begins here. The tech giant then records this spending as revenue, which boosts its quarterly earnings and sends its stock price soaring. Investors see this growth and pour even more money into the AI sector, convinced they're witnessing the next big thing. What's really happening is a circular flow of cash. Money moves in a loop between investors, startups, and cloud providers. This creates the illusion of explosive, organic growth, but it's largely contained within this closed ecosystem. Meanwhile, very little of this capital actually reaches the broader economy or results in products and services that create lasting value for everyday people or businesses outside the tech bubble. Startups, under pressure to grow at all costs, burn through their cash reserves at a rapid pace. Their survival depends on securing the next round of funding, rather than building sustainable businesses. For tech giants, this means their revenue growth is propped up by these startups' spending, not by a broad and diverse customer base that signals real market demand. The cycle keeps feeding itself, creating a self-reinforcing loop, until, inevitably, investor confidence wavers and the flow of money slows or stops. In the end, it's a financial engine running more on hype and speculation than on sustainable profit or real-world impact. The question is, how long can this closed loop keep spinning before it breaks? Here's how the circular capital loop works in practice. It's a cycle that's both clever and risky, and it's quietly reshaping the tech industry from the inside out. Imagine Microsoft or Amazon investing millions into a hot new AI startup. Let's call it Future AI. These tech giants are eager to back the next big thing, and their investments make headlines, signaling confidence in the future of artificial intelligence. But here's the twist. Future AI spends a huge chunk of that investment right back on Microsoft Azure or Amazon Web Services, renting massive amounts of cloud computing power to train its AI models. The money flows out of the tech giant's investment arm and then flows right back in through its cloud division. Microsoft then books this spending as cloud revenue, which looks great on quarterly reports. The company's stock price rises, its market value grows, and investors see a thriving business with booming demand for its services. The investment comes full circle, making the tech giant appear even more successful and innovative. Executives celebrate, and the cycle encourages even more investment in the next round of startups. This pattern repeats across the industry. Google funds startups that spend heavily on Google Cloud, Amazon does the same with AWS, and the cycle continues. Each tech giant is fueling its own growth by recycling capital through the ecosystem. The illusion is that AI demand is exploding, but in reality, most of the customers are other AI startups, all drawing from the same pool of venture capital and big tech investments. It's a closed loop that can make the market look much bigger than it really is. If funding dries up, these startups can't afford the expensive cloud services they rely on, and suddenly, the tech giants' impressive revenue numbers start to evaporate. The entire system is built on a steady flow of outside money. The system props itself up until the flow of money stops. When that happens, the consequences can ripple through the entire tech sector, causing instability and sudden downturns. The entire structure is far more fragile than it appears, and the illusion of endless growth can shatter in an instant if the capital loop breaks. The stock market's AI-driven surge is misleading. A handful of tech giants now make up over a third of the S&P 500's value, masking stagnation elsewhere. For most investors, this looks like prosperity, but it's a risky concentration. Smaller businesses struggle while tech giants post record profits, creating a dangerous disconnect. As these giants grow, index funds are forced to buy more of their shares, pushing prices even higher. This self-fulfilling cycle inflates the bubble and increases systemic risk. The market's apparent strength is built on a narrow foundation. If tech stumbles, the whole system is exposed. For AI to be revolutionary, it must deliver real value to businesses. Despite massive investment, most companies using generative AI aren't seeing significant returns. Over 90% of firms report no material financial benefit from AI adoption. High costs and limited productivity gains make widespread adoption difficult. The ROI just isn't there yet, leading to cautious business spending and slowing adoption. The entire AI investment thesis depends on future profits that may never materialize. If demand doesn't grow, the foundation of the AI boom crumbles. The payday everyone expects could be much smaller and much further away than the hype suggests. If the AI bubble bursts, the fallout won't be limited to Silicon Valley. Mass layoffs could ripple through tech and local economies, challenging the promise that AI would create more jobs than it destroys. The energy sector, which has invested heavily in new infrastructure for AI, could be left with stranded assets and higher costs for everyone. A crash in tech stocks would wipe out trillions in retirement savings and expose the illusion of economic strength. Governments, having invested billions in AI, would face failed projects and rising public debt. The shock could tip the global economy into recession. Public finances would be strained, forcing tough choices on spending and taxes. The risks are systemic, touching every part of the economy. Normally, failed private bets hurt only investors, but AI is now framed as a national priority. The narrative turns private risk into a public obligation. Failure is politically unacceptable. If the bubble bursts, governments will face pressure to bail out tech giants and AI startups. Profits are privatized, but losses could be socialized, with taxpayers footing the bill. Bailouts would add to public debt, leaving less for healthcare, education, and infrastructure. Higher taxes or service cuts could follow, along with inflation that erodes savings. The public could end up paying for a speculative frenzy they never joined. The consequences would be deep and long-lasting. The line between private risk and public cost is vanishing. The too important to fail argument is supercharged by national security concerns. AI is now central to military, intelligence, and cybersecurity operations worldwide. A collapse in the domestic AI industry would be seen as a threat to national defense. This makes government intervention and bailouts almost inevitable. Knowing this, private companies take bigger risks, confident they'll be rescued if things go wrong. Governments are already pouring billions into AI, blurring the line between public and private interests. The promise of future government contracts inflates valuations even further. The national security narrative provides a backstop for the AI bubble. It's nearly impossible for policymakers to cool speculation without being accused of undermining national interests. Taxpayers are left underwriting private gambles in the name of security. AI holds real promise, but the current boom is driven by hype, speculation, and concentrated power. We need to move forward with caution and demand evidence of real value, not just flashy demos. Businesses should focus on practical AI applications with clear returns, not just trends. Investors must look past the hype and scrutinize fundamentals. Policymakers should foster competition and prevent private risks from becoming public liabilities. No company should be too big to fail. That only encourages recklessness. The future of AI depends on the choices we make now. By demanding accountability and prioritizing genuine value, we can steer AI toward a stable, equitable future. The promise is real, but so are the risks. Let's proceed with our eyes wide open.